Chinese firms have historically focused on their domestic market, but this is rapidly changing. In 2023, firms listed in China generated $1.5 trillion in foreign revenue, whereas $5.8 trillion generated by American firms and $6.4 trillion by European ones. China's outbound foreign direct investment, FDI, stock was 17% of its GDP, compared to 34% for America and 49% for Germany. Despite this, since 2016, Chinese firms' foreign sales have more than doubled, and greenfield FDIs surged to a record $162 billion in 2023, up from $50 billion in 2022, with nearly 75% invested in manufacturing. The shift is driven by the declining appeal of China's domestic economy, marked by slower growth and fierce competition. The average return on invested capital for Chinese non-financial firms was only 4.9% in 2023, compared to 6.6% for European companies and 8.7% for American ones. The faltering domestic economy is pushing more Chinese firms to go out, targeting richer markets where consumer spending outside China is concentrated. However, expanding in these markets is increasingly difficult due to the political shift against Chinese firms, with Chinese carmakers facing tariffs on both sides of the Atlantic and firms like TikTok facing potential bans in the U.S. In response, Chinese firms are shifting production to other developing countries to circumvent trade barriers. This strategy has been successfully used by Chinese solar firms, which have moved production to Southeast Asia to avoid American tariffs. Chinese investment in Global South manufacturing is surging, with 9 of China's top 10 greenfield FDI destinations in 2023 located there. For example, BYD opened a car factory in Thailand in July 2023, and CATL is expanding in Southeast Asia and exploring investments in Morocco and Turkey. Trade data indicates that these new factories depend heavily on Chinese components, with imports of intermediate goods from China nearly tripling in the past decade in the top 10 greenfield FDI destinations. The main driver behind these investments is tariff avoidance, according to Johnson, one of Jefferies. Although Chinese factory wages have quadrupled since 2010 to over $8 an hour, making them higher than in Southeast Asia, manufacturing in China remains cheaper due to economies of scale and developed infrastructure. China's Belt and Road Initiative has also channeled over $1 trillion into infrastructure across the Global South, making these regions more attractive for manufacturing. However, Western governments are cracking down on Chinese firms using Global South factories to disguise the origin of goods. In June 2023, American tariffs were extended to many solar products made by Chinese firms in Southeast Asia. As Chinese firms face growing hostility in the West, they are increasingly targeting the Global South. Chinese firms' sales in these regions have nearly quadrupled since 2016, reaching $800 billion in 2023, surpassing their sales in rich countries. In Africa, half of the smartphones are made by Transsion, a Chinese company, while Chinese carmakers account for 18% of sales in Thailand and half of the car sales in Russia. To strengthen their presence, Chinese firms are also shifting production to the Global South, which fosters goodwill and positions China as a development partner rather than a threat. China Incorporated is gaining momentum even in non-manufacturing industries, such as Coty Coffee, which now has over 7,000 stores across Asia and the Middle East. Chinese firms are rapidly closing the gap with Western multinationals, having reduced the foreign sales ratio from 15:1 in 2016 to 5:1 in 2023.